there, and welcome to the Property Wealth Podcast. Today, we're diving into a really exciting topic. It's one of those hands-on strategies that can make a real difference in your real estate journey.
Absolutely, Sarah. We're talking about driving for dollars. It's a method that can really help you spot those hidden deals right from your car, which is pretty cool, right?
Yeah, it really is. So for those who might not be familiar, driving for dollars essentially means looking for potential investment properties while you're out and about.
Exactly. You can spot distressed properties, vacant homes, or even places that just look like they could use a little TLC. It's a great way to find opportunities that might not be listed on the market yet.
And it's not just about finding properties either. We'll also discuss how to evaluate those properties, why building relationships in your community is so important, and, of course, how to approach the owners if you think you've found a gem.
Right, and we'll touch on some practical tips for getting started, because I know it can feel a bit daunting at first.
For sure, but we're here to reassure you that it's totally doable. Just think of it as a little adventure.
And who doesn't love a good adventure, right?
Exactly! So let's hit the road and get into the nitty-gritty of driving for dollars. Where should we start, Mike?
Sarah, when we talk about driving for dollars, it really hits home for folks over 40, especially now. With retirement timelines looming, many are feeling the pressure to build a solid financial foundation.
Absolutely, Mike. It's like, if you're in your 40s or 50s, you're probably starting to think about how to secure your future, right? And property can be such a powerful tool for that.
Exactly. Consider inflation. It's been a hot topic lately. The cost of living is rising, and it can make saving for retirement feel like a moving target. But real estate tends to appreciate over time, often outpacing inflation. It's like a hedge against those rising costs.
That's a great point. I've heard stories from listeners who, despite feeling the pinch, have found success by investing in properties. Like, there's this couple I spoke to who started investing in rental properties a few years back. They didn't have much experience, but they were willing to learn and adapt.
Right, and they probably realize that owning real estate can provide a steady stream of income, which is crucial. It's not just about the property itself, but the cash flow it generates. That can help in those retirement years, when you may not want to rely solely on savings or Social Security.
Exactly. And for many, it's about leaving a legacy for their kids or grandkids. I spoke to a listener recently who bought a duplex. She's living in one unit and renting out the other. It's not just helping her financially now, but she's also setting up her children for future opportunities.
That's inspirational. It's like she's creating a safety net, not just for herself, but for her whole family. And when we look at the current economic trends, there's a shift happening. More people are looking towards rental properties as a way to build wealth, especially with the market fluctuating.
For sure. And I think there's an emotional side to this as well. The feeling of financial security that comes from owning property, it's comforting, especially as we age.
Yeah, exactly. It's not just about the numbers. It's about peace of mind. Many people in their 40s and 50s are reevaluating their financial situations. They want to feel secure in their later years, and real estate can play a significant role in that journey.
I've even heard from investors who say that just having that additional income from rental properties has alleviated a lot of stress. They feel more prepared for unexpected expenses, like medical bills or home repairs.
Right, and that's the beauty of real estate. It can be a buffer against those surprises, and it's something tangible that you can see and touch, unlike stocks or bonds. People often feel more in control when they invest in something they can directly manage.
Definitely. And for those just starting out, driving for dollars is a practical way to find investment opportunities without needing a lot of capital up front.
Exactly. It's about being proactive. I remember a story from an investor who drove around neighborhoods looking for distressed properties. He found a house that was in pretty rough shape, but had great potential. He bought it at a low price, renovated it, and turned it into a profitable rental.
That's a perfect example. And what's great is that this strategy can work in any market, whether it's a buyer's or seller's market. If you can identify opportunities, you can capitalize on them.
Right, and I think that's especially important now with the current market shifts. There are always deals to be found. It's just about knowing where to look and being willing to take action.
And I love that driving for dollars can fit into anyone's schedule. For those over 40, it's about making the most of your time. You can drive around on weekends or even after work. It's a flexible strategy that fits into busy lives.
Absolutely, and it's also a chance to explore communities. As you drive around, you might discover neighborhoods that you didn't even know existed, each with its own unique vibe and investment potential.
Oh, for sure. And I think that sense of exploration can be invigorating, especially for those who might feel stuck in their current routines.
Yeah, and it connects you to the community. You're not just hunting for deals, you're engaging with the local area. That can help you make more informed decisions about where to invest.
Definitely. And I think it's important to remember that investing in real estate isn't just about the financial gains. It's about enhancing your quality of life, too.
Exactly, Sarah. And speaking of quality of life, let's dive into some core strategies for driving for dollars. We can help our listeners understand how to effectively find those deals and make the most of their investing journeys. So let's dive into some core strategies for driving for dollars. You know, one of the simplest rules of thumb that I always share is the 1% rule.
Oh yeah, I've heard about that one. It's a great starting point, right?
Exactly. So the 1% rule suggests that you should aim for a property to generate about 1% of its purchase price in monthly rent. For example, if you buy a property for $200,000, you'd want to see it renting for at least $2,000 a month.
That makes sense. It's a quick way to gauge whether a property is worth pursuing. But what if it doesn't meet that 1% threshold?
Well, if it doesn't, you might want to dig a little deeper. Look at the potential for appreciation, the neighborhood's growth, or even if there's room to increase that rent after some renovations.
Right, like maybe updating the kitchen or adding some curb appeal could justify a higher rent.
Exactly. And that brings us to another rule of thumb, the 50% rule. This one's about expenses. You should estimate that about 50% of your rental income will go towards operating expenses.
So if we stick with our $2,000 rental from before, you'd expect to budget around $1,000 for things like maintenance, property management, and taxes?
Spot on. And that means your cash flow would be $1,000 a month, which is pretty solid. But remember, this is just a guideline.
Yeah, it's good to have an idea, but every property is different.
Absolutely. And speaking of differences, let's talk about cap rates or capitalization rates. They help you evaluate the potential return on investment.
How do you calculate that?
Simple, really. You take the annual net operating income, NOI, and divide it by the property's purchase price. So if the property generates $24,000 in annual income, and you buy it for $300,000, your cap rate would be 8%.
Got it. That's a good way to compare properties. Higher cap rates usually mean better returns, right?
Yes, but there's a balance to strike. Higher cap rates can also indicate higher risks, so you've got to weigh that against the market conditions.
Makes sense. And when you're driving for dollars, what should we be looking for in properties?
Great question. Look for signs of neglect. Overgrown lawns, peeling paint, or boarded up windows. Those are often indicators that a property may be distressed and could be available at a discount.
Right, and that can lead to some great deals. But how do you evaluate those deals once you find them?
A good checklist is essential. Start by assessing the property's condition. Are there major repairs needed? How's the roof, plumbing, and electrical?
And then what about the neighborhood?
Definitely consider that too. Research local schools, crime rates, and nearby amenities. A good neighborhood can significantly increase a property's value.
Yeah, you could have a fantastic property, but if it's in a rough area, that's a tough sell.
Exactly. And don't forget to check the local market trends. Are property values rising or falling?
So it's kind of like a holistic approach, right? You're looking at the property and its surroundings.
That's a perfect way to put it. And once you've narrowed down your options, think about financing.
Financing can be a bit intimidating for some folks, though, can't it?
For sure. But there are several options like conventional loans, FHA loans, or even private money lenders.
What's the difference, really?
Well, conventional loans usually require a higher credit score and a larger down payment. FHA loans are more lenient, allowing for lower credit scores and smaller down payments, but they come with insurance costs.
And private money lenders are?
Those are individuals or groups who lend money based on the property value rather than your credit score. They can be more flexible, but also tend to charge higher interest rates.
So it's really about weighing your options and finding what works best for you, right?
Exactly. And once you secure financing, make sure you have a solid plan for managing the property. This includes knowing how to screen tenants, set rental rates, and maintain the property.
Speaking of tenants, how do you ensure you find the right ones?
It starts with a thorough application process. Background checks, income verification, and checking references are crucial.
And then there's setting the right rental price, which can be tricky.
Yes, it's a balancing act. You want to attract good tenants while maximizing your income. Research similar properties in your area to find the sweet spot.
It's like a constant learning process, isn't it?
Absolutely. The market is always changing, and being adaptable is key.
But it sounds like if you follow these strategies, you'll be in a much better position to succeed.
That's the goal. Now, as we wrap this up, it's important to talk about some common pitfalls that investors might encounter when driving for dollars.
Oh, I can only imagine there are a few. Let's get into that.
So, one of the biggest pitfalls I see, especially with newer investors, is over-leveraging.
Yeah, that's a classic one, right? People think they can just take on as much debt as possible to maximize their investment, but...
Exactly. They get caught up in the excitement of buying multiple properties and forget to consider, well, what happens when the market shifts or unexpected expenses crop up?
Right. I've heard stories of investors who thought they were invincible, only to face a downturn, and suddenly they're drowning in payments.
Yeah, I remember one client who bought 3 properties within a year, all with high leverage. When the market dipped, not only was he struggling to cover the mortgage, but he also had to deal with repairs that he hadn't budgeted for.
That's tough. So, what do you think he could have done differently?
Well, first off, he should have focused on cash flow, ensuring each property could cover its expenses without relying solely on appreciation.
That makes sense. Cash flow is like the lifeblood of real estate investing.
Absolutely. And then there are bad tenants.
Yes. That can be a real nightmare.
It can really derail an investment. I had another client who jumped at a tenant who seemed perfect on paper but ended up being a nightmare.
What happened?
Well, they had a history of late payments, which he overlooked because they had a good job and decent credit. But once they moved in, they started missing payments, and the property needed unexpected repairs.
So frustrating.
It is. And that's where doing thorough background checks and getting references really pays off. Not just looking at the numbers, but getting a sense of the person behind them.
Right, like actually talking to previous landlords and not just taking everything at face value.
Exactly. And then there's the issue of ignoring cash flow.
Yeah, that ties back to over-leveraging, doesn't it?
Very much so. I've seen investors get so caught up in the numbers that they forget to account for things like property management fees, maintenance, and vacancy rates.
Those hidden costs can really add up.
Definitely. I had one investor who bought a property thinking the rent would cover the mortgage, but when he factored in management fees, maintenance, and insurance, he was in the red every month.
Wow, that's a tough lesson to learn.
It really is, and it's so important to have a buffer, Always plan for the unexpected.
Speaking of unexpected, what about timing the market?
Ah, yes. The classic mistake of trying to predict market highs and lows.
So many people get caught up in that, thinking they can time their investment perfectly.
Exactly. I remember a couple who waited for what they thought was the perfect time to buy, only to miss out on great opportunities because they were waiting for prices to drop.
And then prices just kept rising, right?
Right. They ended up buying at a higher price than they would have if they'd acted earlier.
It's so important to have a long-term perspective, isn't it?
Yes, and to focus on your own goals rather than trying to chase market trends.
So true. And then there are those hidden costs we mentioned earlier.
Right. Even seasoned investors can overlook things like closing costs, property taxes, and unexpected repairs. I had a colleague who forgot to budget for a roof replacement.
Ouch.
Yeah, it ended up costing him thousands he hadn't planned for, and it really hurt his cash flow.
So what should investors do to spot those red flags early?
Well, first, do your due diligence. Research the area, understand local laws, and factor in all potential costs before you buy.
That sounds like a solid plan.
And consider building a team of reliable professionals. Having a good real estate agent, accountant, and property manager can help you navigate those complexities.
That makes a lot of sense.
They can provide insights that you might not see on your own. And also, always have a contingency fund.
Yes, it's like having an emergency fund for your investments.
Exactly. Just knowing you have that cushion can give you peace of mind.
And it allows you to act quickly if something comes up, right?
Absolutely. And, if you do find yourself in a situation where you've made a mistake, it's not the end of the world.
Yeah, what's essential is learning from those experiences.
Right. Assess what went wrong, seek advice, and adjust your strategy moving forward.
So it's all about being adaptable and resilient.
Exactly. Real estate investing is a journey, and you'll encounter bumps along the way. But with the right mindset and strategies, you can navigate those challenges and come out stronger.
Love that. So let's talk about next steps. What can our listeners do right now to start avoiding these pitfalls?
Well, first, take a close look at your finances.
Yes, and make sure you're not over-leveraging.
Right, and then create a detailed budget for any potential properties you're considering.
And definitely do your due diligence on tenants too.
Absolutely. It's all about preparation and being proactive,
Exactly.
With that mindset, you'll be well on your way to building that long-term wealth you're aiming for. All right, so let's dive into some immediate steps people can take right now to get started with driving for dollars.
Yeah, I think the first thing is just to get out there and start looking, right? Like, grab a notepad, or even just use your phone to jot down addresses of properties that catch your eye.
Absolutely. And you don't have to go all out at first. Just pick a neighborhood you're familiar with, or even one that interests you.
Right, and while you're driving, keep an eye out for properties that look distressed or maybe unkempt. Those are often indicators that the owner might be motivated to sell.
Exactly. And once you've noted down some addresses, you can use tools like Zillow or even Google Maps to get more information on those properties.
Oh, and the Bigger Pockets calculator is a fantastic tool for analyzing potential deals, isn't it?
Yes, it's super user-friendly, and it helps you crunch the numbers on potential cash flow, renovations, all that good stuff.
And don't forget about Deal Check. It's great for comparing multiple properties and quickly understanding their investment potential.
Definitely. And if you're curious about rental prices in the area, Rentometer is a solid app for that. It gives you a good idea of what similar properties are renting for.
So let's say someone finds a property they're interested in. What's next?
Well, they should try to get in touch with the owner. If the property isn't listed, you can often find ownership information through your local MLS or county records.
That's a little bit of a deep dive, but it's totally worth it. Just imagine finding a hidden gem.
For sure. And speaking of digging deeper, it might also be helpful to connect with local real estate meetups.
Oh, definitely. Networking can open so many doors. Even if you're just starting, meeting people in the industry can provide insight and support.
Right. And even if you're not sure where to start, just attending one meetup can spark ideas or lead to potential partnerships.
I think creating a habit of analyzing one deal a week could be a great way to build your skills.
That's a fantastic idea. It keeps you engaged without being overwhelming. Just pick one property, whether it's one you found or something online, and run the numbers.
And reading books or listening to podcasts can really enhance your understanding too. What do you recommend?
Well, I think the book on rental property investing by Brandon Turner is a must-read. It covers so much ground and is really accessible.
And for podcasts, I love Bigger Pockets podcast. They bring on real investors who share their stories and tips.
Exactly. It's like learning from a community. You can absorb so much just by listening to others' experiences.
And starting small is key. Even if it feels like a slow process, building good habits will pay off in the long run.
Right. So whether it's driving for dollars, analyzing deals, or connecting with others, just take that first step.
And remember, it's all about progress, not perfection. You don't have to have it all figured out from the start.
Well said. So with these tools in your pocket, you're ready to move forward. Let's recap what we've covered today. So as we wrap up this episode, let's quickly recap some key takeaways from our discussion on driving for dollars.
Yeah, absolutely. One of the big points was identifying those hidden gems in your local area, right? Just driving around can reveal opportunities you might not see online.
Exactly. And the importance of being proactive. If you're out there looking for properties, you're more likely to find deals that others might overlook.
Right, and we talked about leveraging technology to help streamline that process. Using apps to track potential properties can really save time and make things more efficient.
And don't forget, networking with other investors and locals. Those connections can lead to some fantastic insights and opportunities.
For sure, building relationships is key. It's not just about finding a property. It's about creating a community around your investing journey.
Well, and that leads us to our final takeaway. It's all about taking action. Just getting started, even if it feels a bit daunting at first.
Absolutely. Taking that first step into real estate investing can be the beginning of building long-term wealth, and it's never too late to start.
So, for everyone listening, if you found value in today's episode, we'd really appreciate it if you could like and subscribe.
And don't forget to leave us a comment. We'd love to hear your biggest takeaway or any questions you have. And if you know someone over 40 who's interested in real estate, share this episode with them.
Next time, we'll dive into something really exciting. How to negotiate like a pro with sellers.
Yes! You won't want to miss it. It's all about those negotiation tactics that can really make a difference in your investing journey.
Thanks for joining us today. We're so glad you're part of this journey with us.
Until next time, keep exploring those opportunities. And remember, your dream of wealth through real estate is totally within reach.
Take care, everyone.
Bye for now.